I-Remit v. SIR, GR number 209755, November 9, 2020. Facts. In its assailed decision, the CTA and bank dismissed the petition for review filed by petitioner I-Remit, Incorporated, I-Remit, for refund of excess taxes from Respondent Commissioner of Internal Revenue, SIR. Section 127(b) provides, SEC 127. Tax on sale, barter or exchange of shares of stock listed and traded through the local stock exchange or through initial public offering. XXXX(b) Tax on shares of stock sold or exchanged through initial public offering. There shall be levied, assessed, and collected on every sale, barter, exchange, or other disposition through initial public offering of shares of stock in closely held corporations as defined herein, a tax at the rates provided hereunder based on the gross selling price or gross value in money of the shares of stock sold, bartered, exchanged, or otherwise disposed in accordance with the proportion of shares of stock sold, bartered, exchanged, or otherwise disposed to the total outstanding shares of stock after the listing in the local stock exchange, up to 25%, 25%, 4% over 25%, 25%, but not over 33 and 1/3%, 33 and 1/3%, 2% over 33 and 1/3%, 33 and 1/3%. 1% The tax herein imposed shall be paid by the issuing corporation in primary offering or by the seller in secondary offering. XXXX. Petitioner I-Remit is a domestic corporation listed with the Philippine Stock Exchange. Respondent SIR is vested with the authority to decide, approve, and/or grant refund of national internal revenue taxes. The dividend used by I-Remit in arriving at the corresponding tax rate of 4% was 140,604,000, which was the total amount of shares sold to the public in both primary and secondary offerings. On April 18, 2008, petitioner filed a claim for refund with the Revenue District Office Number 43 of Pasig City, and thereafter with the respondent. Issues. Interpretation of Section 127(b) of the National Internal Revenue Code, NIRC, specifically on the computation of tax on sale of shares of stock sold or exchanged through initial public offering. The sole issue in this case is whether the tax on sale of shares of stock sold or exchanged through initial public offering under Section 127(b) is separately computed for shares in primary and secondary offerings. Ruling. We rule in the affirmative. The word every precedes the word sale. The use of such word is clear and leaves no room for interpretation. Each sale of shares of stock in closely held corporations through initial public offering is taxed under Section 127(b). The tax on every sale under Section 127(b) is in turn based on the gross selling price or gross value in money of shares of stock sold, bartered, exchanged, or otherwise disposed in accordance with the proportion of shares of stock sold, bartered, exchanged, or otherwise disposed to the total outstanding shares of stock after the listing. Since tax is imposed on every sale of shares of stock, there is a need to determine which sales are covered in the sale of shares through initial public offering. On this score, the second paragraph of Section 127(b) precisely provides for the types of sales involved: sale by the issuing corporation in primary offering, and sale by each of the corporation's shareholders in secondary offering. Section 6(c) did not supplant or modify Section 127(b). As discussed above, Section 127(b) is clear in requiring a separate computation of tax on shares offered in primary and secondary offerings. Thus, Section 6(c), in illustrating how the tax should be computed separately, is consistent with Section 127(b). RR 03-1995 was the prevailing rule during petitioner's initial public offering on October 17, 2007. It is apparent from a plain reading of RR 03-1995 that the sale of shares in primary and secondary offerings are separately treated. By expressly differentiating between the sale of shares in primary and secondary offerings, RR 03-1995 made it clear that the corresponding tax shall also be separately computed. Thus, even during the effectivity of the old tax code and RR 03-1995, the tax on sale of shares in primary and secondary offerings have always been separately computed. In fine, we rule that the tax on sale of shares of stock in closely held corporations sold or exchanged through initial public offering under Sector 127(b) is separately computed as to shares offered in primary and secondary offerings. Wherefore, the petition for review is denied. Principles. Every sale of shares under Section 127(b) taxed. A plain reading of Section 127 B shows that tax is imposed on every sale, barter, exchange, or other disposition through initial public offering of shares of stock in closely held corporations. The tax herein imposed shall be paid by the issuing corporation in primary offering or by the seller in secondary offering. The principle that a statute must be so construed as to harmonize and give effect to all its provisions whenever possible. The word total is used to describe the outstanding shares after the listing or the divisor in the computation, while the same word is noticeably not used in describing the shares offered during the initial public offering or the dividend in the computation. Key distinction is readily apparent from a reading of Section 127(c) of the NRC, which expressly provides for a separate time and manner of payment of tax in primary and secondary offerings as well as the party liable to pay the corresponding tax. See return on capital gains realized from sale of shares of stocks. 1. Return on capital gains realized from sale of shares of stock listed and traded in the local stock exchange. It shall be the duty of every stockbroker who effected the sale subject to the tax imposed herein to collect the tax and remit the same to the Bureau of Internal Revenue within 5 banking days from the date of collection thereof and to submit on Mondays of each week to the Secretary of the Stock Exchange of which he is a member a true and complete return which shall contain a declaration of all the transactions effected through him during the preceding week and of taxes collected by him and turned over to the Bureau of Internal Revenue. 2. Return on public offerings of shares of stock. In case of primary offering, the corporate issuer shall file the return and pay the corresponding tax within 30 days from the date of listing of the shares of stock in the local stock exchange. In the case of secondary offering, the provision of subsection C1 of this section shall apply as to the time and manner of the payment of the tax. Section 6(c) of RR 06-2008 is consistent with Section 127(b). RR number 03, series of 1995-49, RR 03-1995, considers as separate transactions the sale of shares in primary and secondary offerings. The percentage tax return corresponding to Section 127(b) requires a separate computation. A vested right may not spring from a wrong construction of law. To recall, the second division of the tax court stated that a joint computation, using the total number of shares sold during the IPO, should determine the IPO tax rate to be used. However, the pronouncement was an erroneous interpretation of Section 127(b), from which no vested right may arise. 55. Thus, it cannot be the source of any vested right in favor of petitioner.